Thank you very much. I'd like to welcome everyone to Sydney, especially those who have travelled from a long distance, people from Perth and Darwin. I'm very grateful for you coming today and joining us in this conversation around ESG. Also would like to pay my respects to traditional owners of this land, past, present and emerging. I'm very grateful today also to be here. I think we should also say thank you to our founders, Paula and Kirk, who are the hosts for this fantastic function. They've done a great job in organising this, and thank you very much. And also thank you to all the people in the back office who have done a great job. Ben has done the brochure for you, so if you need any art, go see Ben, and everyone else is helping Paula around behind the scenes. So thank you very much for those as well, please. So we're very lucky here at TrueGreen Group to be partnering with Goldman Sachs. Goldman Sachs is clearly a global leader in the finance, investment and advisory around the world. And I'm joined on the panel here today by three of their foremost ESG experts. Obviously joining me is Brett, Nicole and Rakesh, and we're going to have a little conversation over the next 20 minutes around ESG investing and emerging trends. And that's a great way to start, because when you think about ESG trends, it's not just about Australia, but with Goldman Sachs global pedigree, do you mind each of you just introducing us to what you think the emerging trends are globally and how it's affecting us in Australia?
Yeah, absolutely. First off, thank you, Scott and team, for having us here, and thank you all for taking time out of your days to be here with us. I think maybe the best way to go about it is kind of how Goldman is looking at it from kind of the global level, and then we'll break down into each region just very quickly and tie that back to Australia. So from the global level at GS, we're really trying to understand and digest what is driving this ESG market, right? In 2020, we saw $270 billion worth of ESG flows, and this year, we're easily going to pass that, we believe, right? To me, it really comes down to UNPRI, so the United Nations Principles of Responsible Investing. We have over 4,000 signatories globally now signed up to that, which represent 100 trillion of AUM. So to the extent that the UNPRI is making changes of which the ESG community now needs to alter their portfolios and investment decisions off of, we need to make sure that we're ahead of the curve in that. Two of probably the most prominent that you've heard of are the SDGs, or the Sustainable Development Goals, and TCFD, Task Force on Climate-Related Financial Disclosure. SDG is ultimately trying to create a formal language around ESG, and then TCFD is basically looking and going, okay, a lot of companies have financial disclosure, we need to have them have climate disclosure as well. So that's where our main focus is up top. I then look at Europe, and Europe has really been the vanguard in my mind of ESG, and I think many here would agree with that. And there it's really about decarbonization right now. Can we meet the 2050 goals that we've set? And ultimately, what does that transition look like to get there? And right now you're seeing things like the EU taxonomy, Green Deal, and SFDR. And those are ultimately, I would say, the regulations that are going to be put in place to incentivize, but also potentially penalize companies and investors for not necessarily meeting or making that transition on time. So that's probably where our main focus is in Europe right now. And if we look at the EU taxonomy, that's largely geared towards the companies, and SFDR is largely towards investors and ensuring their investments are done in a green manner, not just that they have that ESG banner associated with it. And I guess quickly, just a stat that came across yesterday in one of our conversations that I found fascinating was actually that countries that represent 70% of total CO2 emissions have now tied themselves and pledged to net zero. That is going to be an incredible force moving forward in the ESG community. Next, I really look at the US after that. And this has really been the rise of the ESG retail investor, and even to a certain extent ESG activists, which I find quite interesting at this point in time. So starting with the ESG retail investor, you've seen the rise of thematic funds garnering a lot of assets, and the main one has been clean energy. You've seen ESG passive funds rise, and then you've also seen in the active space a lot of new different offerings out there that are targeting or looking at ESG in different ways, which I think is a promising avenue that we're following here in Asia as well. If we look at the activist side of things, this to me is just a clear sign of a transition of power. You used to have people sitting on boards and senior managers that were accountable to the financials, and now they're being replaced or taken off as a result of not meeting ESG guidelines or their shareholders' expectations. So to me, that's exciting. That's demonstrating a clear change in the market. And words like forensic accountant are becoming more commonplace, and that's an example of that. So if I tie that back to Asia, I think it's fair to say that Asia is maybe a step or two behind, but that doesn't mean that we're at a low base by any means. I think we actually excel in a lot of categories. But how does it resonate to Australia? Just tying it all back together, 200 of the 4,000 signatories for UNPRI are domiciled in Australia and New Zealand, so obviously that's relevant for us here today. Australia is going to be central in that decarbonization efforts. There's going to be companies here, both locally and then those that have kind of an offshore presence, that will be able to basically profit or potentially be impacted by offshore regulation, so they need to be very aware of that. And then we've seen a huge rise in bespoke ESG managers here locally and a changing of the ESG platforms from everyone from your super funds down to your private wealth managers. So Australia is definitely in the mix of it here as well.
Look, I think Brett has covered the field well, but maybe to put in context where we all sit, I sit in our investment banking team, so focus on covering the corporates, whereas Brett tends to engage with equity market investors. So I suppose moving across to what we're seeing globally with our corporate clients and comparing that to what's happening in Australia, I think it's no exaggeration to say that this really is the industrial revolution of our time. Most of the focus to date has been on the E in ESG, and to Brett's point, we've had the EU announce the Green Deal, which is expected to drive 10 trillion euros of investment in renewables. We're going to see Biden put in place plans that will likely result in a quadrupling of investment in renewables in the US. And to Brett's statistic, that's just the EU and the US. With 70% of the world's emissions now under net zero targets, including China trying to get there by 2060, we see that this is something that's just going to continue to grow. In terms of what that's, and maybe just before I talk about how that's playing out for our corporate clients, I think the other thing that's really emerged over the course of the pandemic is the S has grown in prominence. And we have a sustainable finance group at Goldman's that really just houses all of the insights and research that we're doing on ESG as a company. And the one thing that they flag is that over the last year, the S is now riding in the front seat alongside the E. And so we're also seeing companies really starting to feel pressure to make sure, for instance, the supermarkets aren't selling high sugar foods to consumers. So it's playing out with huge focus on clean tech, auto tech. We're seeing premium valuations for anything that's viewed as green. So in some of the renewables auctions that we've seen offshore in Europe, those auctions have concluded at a 25 times revenue multiple versus 10 times of EBITDA for a higher carbon company. And for all of our clients, therefore, across the world, they're looking at how they acquire lower carbon businesses, how they develop the capabilities for lower carbon businesses, and also another area that we're seeing is spin-outs and demergers. So you would have seen the rise of SPACs, or special purpose acquisition companies, in the US this year. A lot of that's playing out with companies just basically working out how they can get value or highlight the value of cleaner tech or auto tech businesses that they have in their portfolio. I think bringing that back to Australia, I think the trend's here in abundance. We've seen high values for renewables. We've seen companies having structural separations to move into their clean division and their higher carbon division. I think the only difference we have is we don't have the same policy backdrop as you've seen in Europe and the US. But interestingly, as we speak to our colleagues offshore, they don't see that as a problem. It's a tailwind, sure, that there is that policy backdrop, but it's certainly not necessary for what's happening offshore. And I think, therefore, we'll probably see Australia absolutely keep pace with the rest of the world in terms of this change.
Yeah, look, I think I sit within the asset management division of Goldman, and I think these guys have sort of touched upon the main themes, but I would say in terms of institutional capital coming into the space, without question, it's every conversation we have at the moment involves some sort of ESG dialogue. And if you look at the quantum of money we run globally, just under $2.5 trillion of capital, roughly 10% of that is in direct ESG strategies. And I will tell you, it's by far and away the most rapidly growing part of our business globally, and actually and specifically in Australia as well. More specifically around ESG, I would say, in terms of institutional dialogue, sort of the two areas where most of the focus is, and we'll sort of come on to some of the details, is really around climate being number one, and impact investing being the second. And we'll sort of touch upon some of the themes there. But similar to the globe, in Australia, without question, the number one sort of mind share, I guess, with clients is very much around ESG and specifically climate.
Thank you, Rakesh. Brett, coming back to you around the equity markets you look after, there's obviously been a lot of commentary in the press in the last couple of months about greenwashing and so forth. In your view, how are the markets making it real versus not real and just being a marketing spin? And how do you differentiate between marketing and making it real?
Yeah, no, that's a great question. What I might start with is kind of like why is this happening in the first place, right? So we need to look back at our asset owner in order to determine this, right? So this is just your everyday investor that's making decisions. What they've decided is that they want their investment capital invested in a responsible and socially acceptable manner. And many times they want to align with their ethical beliefs, right? And ethics can be different, but ultimately that's what they're deriving, and they want to make a positive impact with those. And in doing so, we've seen some natural exclusions in that investment market. So alcohol, tobacco, weapons, fossil fuels have become very prominent, and we've switched that out for investments in something like clean energy. Right, so now when I look across kind of the space and how that's impacting things, ultimately they've had good disclosure and transparency of what they're ultimately investing in, so they've been able to ask for those changes. The ease of actually getting into the market have only become easier through new platforms, free trading, et cetera. And there's a lot of competition out there with asset managers that are trying to differentiate themselves. So it allows the asset owner to ultimately demand this ESG change, right? And I have to bring my kind of tip my hat to the asset management teams globally. And their ability to adapt to this change has just been phenomenal. So they've not only been able to retain assets because of a rebranding, in a sense, towards ESG, but also attract new assets with new products. So the question really comes back to, from a marketing perspective, is it just a marketing gimmick, or is it actually deriving something, right? And to me, I like to think of it more as adaptation to something that was naturally already embedded in people's processes and already there. But the change has really been, it's now front and center. So investors are going to their asset managers, or before they even get there, going, let's run a screen. Is it ESG or is it not ESG? If it's not ESG, it doesn't matter how good your alpha is or how good your performance is, because you're not even getting the chance to come to the table. Right? So once you get that ESG credibility, that's what's important. So asset managers are ultimately putting that foot forward, right? Putting that in the spotlight. Now, it's definitely going to be a marketing exercise for some, but I think what gives me a lot of confidence that this greenwashing can potentially actually lead to some qualitative and accurate data is ultimately you're setting new regulations, such as SFDR that I mentioned previously, that's ultimately going to make it more transparent for the underlying clients to see what is ESG when we lift it up in the hood in these passive vehicles, in these thematic vehicles, in these active funds. So to the extent that you're not actually investing in an ESG credible way, it's going to have reputational brand damage to your business. And so you're going to need to adapt to that. So if we look at SFDR and what it's ultimately asking, there's really 3 articles within that. Article 6 allows you to classify yourself as ESG or non-ESG, and you're going to see the majority of asset managers do that. Then it gets to Article 8 and Article 9, which is just basically how green are you? Light green, Article 8, or deep green, Article 9, right? And we still need to work our way through that, and there's a process and there's difficulties, but at least it's setting a minimum standardization across the market that investors will be aware of, and then once again, it'll be compounding effort after that. So then you really go back to, okay, so asset owners are demanding it. Is it a marketing exercise? No, it's a branding exercise, really about credibility. Can it derive performance, right? And our research teams here, and even our portfolios have demonstrated exactly that. You can derive superior performance from ESG investing. And our research team has done a series of great reports that we titled the ESG Nifty 50 that looks at over 3,000 global ESG managers, right? And it goes, what are the most commonly held ESG names and how have their portfolios performed? And what we can derive from that is that ESG best held names have had total shareholder returns materially above the rest of the market. And they've been able to hold premiums over that time that are materially greater than non-ESG counterparts. So that gives me some hope. The other avenue I like to look at is I think ESG Alpha, as we like to call it oftentimes, is viewed only in the positive manner, right? So how much alpha or how much positive profit did you make off of investing in ESG? The change that I've seen and what I'm trying to point investors to is sometimes called like this delta. So to the extent that a company has previously fallen their share price, you've seen value managers jump at that opportunity because they've recognized intrinsic value and investment opportunity. If it's now associated with an ESG issue, and that's why it's falling, your value manager is no longer able to buy that stock because their underlying asset owners are basically refusing the opportunity for them to do that. And if they do buy it because it's value, they're taking their assets out and they're going and investing in a new strategy. And that's what's most important to a portfolio manager. So the delta, what I'm looking at is how much did it previously fall, and a value manager, for instance, would pick it up off of that discount, to where it falls now, and in many cases, how long it stays down there, because that can be material performance for your underlying investors. So to me, it's driven by the asset owner. It is a little bit of a marketing exercise, but at least we can point to strong performance to kind of correlate with it.
That's a great answer. Thank you, Brett. Rakesh, could I ask you about your institutional asset owners? What are they looking for in that?
Yeah, look, I think, as Brett said, I think the number one, I sort of go back to what's the problem they're trying to solve. And with a lot of institutional, pension funds, insurance companies, and so on, a lot of boards have made commitments to net zero by a particular date. And what tends to often happen is that these decisions get made at the board level, then they sort of trickle down, and then the implementation team sort of say, okay, how are we actually going to do this? And I would say a very large part of the work we have been doing with clients globally, and specifically here in Australia, is really working with the implementation teams to sort of say, okay, you've made this, your board has made this commitment, you've got to get there by a particular date. What might that journey look like? And the reality is there's no one size fits all. It's very specific to different organizations. It's very specific to the culture and the risk appetite of different institutions. And as a result, the path is very different. And the one thing we've really tried to impress upon people is you don't need to do it all at once. It is a journey, and it's going to look very different for different people. So to give you an example, we've been working with one client here locally, where we spent a lot of time with their board, and when they've looked at their portfolio and said, okay, we need to decarbonize our portfolio. Well, what does that mean? It means we've got equity investments, fixed income investments, private investments, and we need to be able to demonstrate that our carbon footprint across those investments is both trending lower, and hopefully that gets us to our net zero targets. And so with this one client locally, we've decided to focus on their listed part of their portfolio, specifically around equities, because that was the area where they had the largest footprint, and consequently probably where some of the lower hanging fruit was. And we're working on an implementation of their equity portfolio for this particular pension fund, which will reduce the expected reduction in their carbon footprint will be sort of 30 to 40%, with very modest levels of incremental risk. Now, what's been very interesting in the exercise, going back to Brett's point, is what we've been actually be able to demonstrate is that if they do this in a particular way and really manage that, transition risk, there's actually, it's an investment opportunity, meaning it's not just a cost to the fund. There's expected incremental returns that they would expect, because hopefully they'll be in a portfolio of companies which are better suited to manage that transition risk, and that should be reflected in the equity values of those companies. So, I would say the sort of the mantra, I think ultimately we've sort of said is like, it's got to do good and do well, meaning it has to stand up financially, any investment has to stand on its own 2 feet financially, in addition to meeting any particular ESG related goals. So I would say that's probably the focus for institutional clients at least.
One of the things that occurred to me when Brett was talking about was the share price indicator when it went down with ESG. That can be for negative reasons.
Yeah.
But are you seeing innovation in the asset owners where the price is going down because there's an investment in that transition and they'll expect to come back up?
No question. I think if you talk to some of our portfolio managers, they will tell you that when they're doing an analysis on a company, it is no longer good enough just to look at the balance sheet metrics. They've got to be confident that that company over the course of time is going to be able to manage that transition risk, because it's highly likely if they don't, either because they're going to be poorly managing regulatory risk, policy risk, consumer preferences, it's likely that that would reflect in that share price over a longer term. Like, I don't think these things happen in any kind of short term, but for longer term investors, that is absolutely critical.
Thank you. And Nicole, in the corporate space, what are you seeing there?
Similar to Rakesh, I mean, a lot of the clients we speak with, all of their boards have set a net zero target for 2050, but they're coming under pressure from their equity investors to have some milestones along the way. People are saying you'll be well and truly gone by 2050. And so we are seeing companies putting themselves under pressure to evolve their strategy now, to get their balance sheet in shape now. And so I think where we see it play out in M&A, ESG has certainly become an important consideration when companies look at whether they're going to acquire a company or an asset. Strategic fit and financial impact reign supreme as the most important considerations. But more and more, whether it's a good ESG fit is a really important sort of subcategory of strategic fit. And we're actually finding in sell-side processes that we're running around the globe, a lot of buyers are saying that we actually need a session on ESG. We need to understand what this company is going to do for our overall profile. So I think that's one area, just big corporate actions that address this trend. I think another area, and we've been working very closely with Rakesh and his team on this, is looking at what companies can do just to improve their existing operations. And some companies are finding that they get to a point with their Scope 1 and their Scope 2 emissions where they sort of squeeze the lemon as hard as they can and they just can't abate the last amount. And so looking at climate solutions where they buy carbon credits, but instead of having them as a financial cost, buying carbon credits that generate a return for them at the end of 10 years, is some of the really interesting ideas that clients are looking at the moment. And the firm did a recent trade with Apple a few weeks ago that's going to offset around 1 million tonnes of carbon dioxide every year, plus generate a return above Apple's cost of capital for them over a period of time. I suppose the last area that we see at the corporate end of the spectrum is financing, and so companies are looking at ways to achieve benefits now in terms of their cost of debt through either raising funds and putting them towards green or social purposes, or even actually having the cost of debt linked to achieving certain sustainability targets. And look, it's early days in Australia, but we're seeing it becoming commonplace over in Europe. And we've even had boards of companies come out and saying going forward, all of our debt raisings will be climate KPI linked. And so I think they're the three key trends for our corporate clients.
Thank you. Clearly, from the discussion, you can see we're in a transition from where we are today. And ideally, the ideal world is some time away. And clearly, Brett and his investors are cracking the whip down the line to see how do we move across that. What do you think are the key opportunities that are going to emerge, or the key themes for the next 12 months coming up in ESG investing? Where's the next go-to place?
Your first one.
Where's the next go-to place on ESG investing? Oh, this is a challenge. I think my client's focus right now is largely on decarbonization, right? So that transition energy stage and the opportunities that are being created from that, both positively and negatively. So when I look across the spectrum, I'm really looking at it going, okay, where are they focused on? It tends to be on the end of that transition line. It then goes towards maybe more the middle category, which is if you are able to meet those 2030 or 2050 targets, do we invest in you in belief in that there's going to be a transition occurring, and can we offset that using carbon credits, for instance? I think that's where the opportunity is, to be honest with you, is in positive ESG momentum, tied to categories that I like to call having ESG discovery value. So not necessarily your obvious answers. You're a pure renewable play, for instance, or you naturally fit into that category. It's, okay, let's look at industries or companies that are a little bit more challenged in nature and see who's best in class, who's working the hardest to get there, because investors will reward them for that. And that, to me, is where the opportunity is coming from in the next step.
Thank you. Nicole?
Yeah, look, it's a really good question. I think for those, I cover the natural resources space at Goldman, so deal with a lot of companies in the energy and infrastructure and power and utilities space. And so a lot of them are under quite some pressure at the moment to address this trend. And I think for them, a real focus is on doing the very best they can with their operations, getting their strategy set so that they've got an answer for these ESG trends, and definitely locking in the longest term capital that they can so that it feels like the window is shutting on the ability of some of these companies to fund themselves, and so they're wanting to try and set themselves up and buy some breathing space to address these issues. And I think one of the real trends looking over the horizon here in Australia is probably activism. We are seeing, after a break because of the pandemic, and it would have been in really poor taste for activists to start attacking companies who are navigating a pandemic, we're seeing activism coming roaring back around the world, and there's a real focus on ESG because ESG is so important to the equity investors, because activists are struggling to find companies that are undervalued because equity valuations are so high at the moment. So I think for the corporates, it's really doing the best they can and watching out for that risk, because it is something that's growing. And then I'd say on the flip side, in terms of ESG investment, we have a lot of clients who say, look, I don't invest in higher carbon opportunities, I don't need to, and my investors would give me a hard time if I were to do that. But on the flip side, there's a lot of companies now looking at, well, could they actually make some very attractive returns through transition investment, helping companies from where they are today to this future of clean hydrogen. And so a lot of thought going into how you can structure instruments and investments through this transition. And so I think that will be an area of growth and probably a lot more clarity over the coming 12 months.
Thank you, Nicole.
I would say the only thing I can say with a high level of conviction about the next 12 months as it relates to this space is that just the volume of capital coming into the space and the demand from clients to find solutions to solve these what are huge problems for all of us continues to be there. So in terms of where will that money end up and what solutions will win, I think that'll take years to play out. I don't think we'll know in months. If we do, then great, but I don't think we will. In terms of the institutional capital, it's very clear that they are focusing on the listed part of their portfolios, because that's where now there is very good data. I would say there's one big difference today versus even 3 years ago, 5 years ago, and before, is just the quality of data that we as investors have to make better investment decisions about where to allocate capital is better than it's ever been. It's definitely not perfect. And I think, often when we're talking to clients, I sort of say to people, look, yes, the data is not perfect. You can always pick holes in different things, but let's not let, perfection get in the way of progress. And I think that's very much the way a lot of clients are looking at this space. So I would say, next 12 months, people continue to decarbonize their equity portfolios, and companies who don't have the right metrics are likely to not be in people's portfolios, and that'll get reflected in their share prices. And I think where there's a really exciting trend is really in the private markets. And in there, I would sort of divide it into sort of two parts. There are sort of nature-based solutions, so whether it's forestry or sustainable agriculture, where there is an increasing amount of what I would describe as patient capital coming into the sector, where people do have 10, 15, 20-year views and are happy for their capital to be locked up for those periods in the expectations that these are going to be the winners of tomorrow. And Nicole mentioned we did a really interesting investment with Apple where around forestry, where that's going to sequester 1 million metric tons of carbon every year. And we're having a lot of conversations around those types of solutions globally, including in Australia. And then I think, the other part of that, so on one end you've got nature-based solutions, and I think over the next number of years we'll see more capital going there. And then the second leg of that stool is really around carbon technologies. So, ways of, sort of direct air capture and other such technologies. I would say those are much more on the high risk, high return end of the spectrum, and people are looking at those, but I would say institutional capital, meaning pension funds and insurance companies, are still looking at them. I haven't seen large amounts of capital being allocated relative to the total capital available. And I think that's a space where I think over the, call it next 24, 36, 48 months, we're going to see more and more capital. And as a result of that, hopefully more and more really interesting solutions that ultimately get us to where we want to get to. But it's a journey, and so I think it's very hard to predict how this river ultimately meanders to an endpoint. I'm not even sure what the endpoint is, actually.
Thank you, Rakesh, and thank you very much for a great conversation. It would be great to find an organisation where you could get the triple threat and invest in ESG. I'll let you ponder that over lunch. Can you please join me in thanking our panel for a great conversation? Thank you very much.